So let's do this, which is accounting for the disposition of general capital assets. What this means is basically removing an asset, right, from your books. So you remove the original cost of asset being replaced or being gotten rid of here. In this case, when you sell an asset, what happens? Or when you get rid of an asset, what happens on your accounting book? First of all, what do you have to do? Credit the asset account to get rid of it, right? What else do you have to do? Get rid of the accumulated depreciation, right? And the difference between the book value and the sale price is the gain or loss. Exactly the same thing in government, okay? And that's what we do here. Notice this. They sold a machine for $500. It had been purchased for $8,000. It was fully depreciated. So what's the book value? So this entire amount has to be recognized as a gain. But notice, gain doesn't show up here. These are government, these are general fund transactions. You can see cash driven, debit cash and revenue. And here's an example for you, which is an example or other financing sources. Okay? And you can see they're removing the equipment, they're removing the accumulated depreciation, cash coming in, gain on sale. This could be broken down into two journal entries, but we did it in one. Okay, here's another one. Assume a building with an original cost of $100,000 is demolished. Cost of the demolition was $5,000. It's fully depreciated. Same exact thing. General fund entries are very easy to figure out because they seem to be what? Cash driven, right? Right? And I don't mean to say it that way because it's wrong to say it that way in some sense, but you can see the focus is on financial resources. Okay? Here, notice what happens. We don't have this issue of accumulated depreciation and buildings. Why? Because general fund doesn't have them. So you don't have to deal with it, right? So here the accumulated depreciation is being removed, the building is removed, and you're recognizing this. Okay? Asset impairment. This is just a special topic within this area because what happens sometimes is, and there are various reasons for it. Sometimes it could be physical damage to an asset which might totally wipe out half the asset. Sometimes it could be you have this wonderful software written, you spent hundreds of thousands of dollars and now it's technologically obsolete. So what happens? You have to write off the software. So that's what we mean by asset impairment. Unexpected circumstances or events which leads to an unexpected, the word is unexpected, decline in the service utility of a capital asset. Okay? That's an asset impairment. Did you study this? Okay, good. And we'll take a look at these questions. Let's go to question 5.9 on page 198. Just read that and we'll okay, so first of all, has an impairment occurred here? Why, who says yes? Why do you think so? That's right. Instead of an office space is now what? Yeah. Are they of the same value? No. So the next question is, and we won't go through the math here, we don't have the numbers, is what approach do you use to calculate that impairment? And what I will do is, I think might be a slide on this. There are 3 different methods for determining the amount of impairment. And notice how they are associated. Physical damage. What does it take to restore it? Okay? That's easy. What do you have to do? Make sure you count also the insurance you're getting in. Just don't calculate the difference as the loss you've incurred, but also what you're getting back in insurance. Okay? Service unit approach. Due to environmental factors and deflated, this is a fancy term, use of impairment due to change in the manner or duration of use. So what do you think of those 3 this one applies to? The last one itself. Okay. There was another problem, wasn't there? 5, 8 was it? What was it? Was it 5, 6 or 5, 8? 5, 6, let's see. Well, you know what? This looks straightforward. Let's try to see if we can figure this out. Read the question on impairment. This is 5, 6 on page 205. All right, so the first question is, should the estimated impairment loss be reported as an extraordinary item or a special item? Now, I don't know if you remember the definition. Okay, let's see. So, is this area susceptible to hurricanes? Okay. What does the extraordinary require? It should be what? Unusual, right? Okay. To be reported as a special item, it has to be what? Unusual and infrequent and be within management's control, right? So this is the first hurricane to hit the city in what, 48 years, right? Okay. So my question to you, based on what we just went through, what do you think it is? Okay, you got 3 choices: extraordinary, special, or ordinary. Who says ordinary? It is actually ordinary. It is ordinary. Okay, go back and look at the definitions again, okay? Yeah. Item number B. What's item number B? Record the estimated impairment loss in the journal for governmental activities at the government-wide level. Well, what's the amount of the loss? And what happened? The building has to be what? Written down, right? By what? Okay. Well, this is the impairment itself. If you look at the question itself, we keep it nice and simple, okay? Based on a restoration cost, estimates that the impairment loss is at $230,000. They give it to you, okay? Yeah, they give it to you. That's all it is. And notice, only at the government-wide level, okay? This is at the GA, okay? That's the impairment. Expense, parks and recreation. Remember I said ordinary? That's expense, right? Okay. And finally, the last question. What's the last question? How should the insurance recovery be reported in the following fiscal year? Well, what should you do with the insurance recovery? You know that you... All right, what happens in the general fund when the money is received for $120,000? You don't have to worry about journal entries, but what would you do when you get the cash in the general fund? What do you do? What account do you credit? You know debit cash. What account do you credit? That's it. You love that other financing source account. So that's, you got that one, okay? So other financing source. What would you do in the under the governmental activities? Debit cash and credit what? No? Because, look, if you charge this as a revenue, as an expense, remember I said you have to net the insurance? What do you have to do? You have to show that as what? As a revenue. If it were the same year, we wouldn't have this issue. But you have to show that either as a program or general revenue for the park department next year. It would have been nice if it were all in the same year, but it's in 2 different years. So you have to, because you charged it as an expense, if you had gotten it this year, what would have number would have been? Instead of 230, it would have been 110, right? But because it's split up in 2 years, what do you have no choice but to do it that way. So that's that question. All right. Any questions? Anybody? Oh, I'm sorry. Impairment. Expenses, park and recreation. Yeah. You guys all right? Yeah. That's the amount of the impairment that's occurred, 230,000. Yes. Other financial sources in the general fund and as program revenue or general revenue in the governmental activities ledger. Yeah. The what? Expense, park and recreation. That's where I'm going to. Okay. Yep. And I'm crediting the building because I have to, that's the amount of the impairment. Yeah, that's the asset. See this last sentence? Report impairment losses net of any insurance recovery that occur in the same fiscal year. Okay, that's what I was referring to earlier. All right, now things will get a little easier. Okay. Okay, so capital projects. So there are 2 types that we'll talk about. The first one is the one which benefits everybody. And these benefit a subset of people. What could be an example? There's a condo complex going on, and you have to run sewer lines or something else, roads, where the town says, we like you there, you'll produce good taxes for us, but you know what? You got to pay for some of this stuff. We're not going to pay for this whole thing. So what do the property owners say? Okay, well, we'll pay you 50%, you put in 50%. The town says, good, we'll go borrow money and special assess you for the other 50%. This is how it works. So these condo owners, and one of the condo owners says, when it gets the bill to pay it, because they pay it over time, I'm not going to pay this. So what does the town do then? Puts a lien on their house. Okay? by putting a lien on the, so do you see what happens with a special assessment? The town, before it does it, it makes sure that it can go after the property owner in the event that they don't pay. But it's done in agreement with them. It's never done like, we're going to do this regardless. It's usually done in an amiable fashion, okay? Not always, but most of the time. And this is what I was saying to you. You know, these are long-lived assets, usually a construction project, long-term planning and extensive financing, have a project life focus instead of an annual focus. Remember the general fund? Like you deal with it annually, right? These are dealing with what? Projects. Doesn't mean that you don't close the accounts at the end of the year, but it's what? Project related. Okay? And this is what I was saying. You know, the mayor just can't go out and say, all right, we're going to do this. It doesn't work that way. If you have in the New Jersey November election, I don't know how many of you have seen, you know, after you do your slate of candidates, there are a couple of questions. And one of them usually is, do you want to have the state borrow money for farmland preservation or for Green Acres project, which is green space, acquiring green space? That's what this is. Because once you say yes, the state goes out and issues general obligation bonds. It has now the authority to do that, right? And can go ahead and then do what they need to do in terms of acquisition of assets. And so you can have a capital project over several years. It cannot be just 1 year. It could be several years. And the project, capital projects account would stay alive during those times. In this case, the federal government says we'll give you $100,000 towards this project. The state recognizes a due from federal government of $100,000 and revenue of $100,000. Okay, and when they receive cash, that will take care of this. And notice how this comes in: due from federal government, program revenues, public works, capital grants, and contributions. Okay, yeah. Okay, now, because what they're saying is you can use it immediately, the money. That's fine. Yeah, good question. Yeah. There's no condition attached to it that you have to use it next year. All right, to get the capital project started, they're planning to issue bonds, but they got to get this thing going. So the general fund says, we'll give you $50,000 to get things started. So it becomes what? Capital projects has what? Cash and interfund loans payable current of $50,000. What's the journal entry in the general fund? They're giving cash, so what is it? Credit cash and debit what? Some kind of a receivable, right, from these guys, from the capital project. Due from capital projects fund, right? Okay. Remember, in fund accounting, entries have to be always balanced. In fact, fund accounting software will make sure you never make one-sided journal entry. It has to, if you ever say due from another fund, that fund better have an equal entry to the one that you have. Okay. Well, it will also do it for proprietary, and if there is between governmental funds and proprietary funds. A good software will do that too. Okay? And this is somebody, one of you was asking me about encumbrances, okay, during lunch. So the contract was signed with an architectural firm for $50,000. They wanted to get the project started till they got the money from the bond. As soon as they signed the contract, what happened? They booked an encumbrance, right? Capital projects fund is a governmental fund. You do what? Have encumbrance accounting. Anything in the governmental activities? Nothing. They don't recognize encumbrances. Okay. All right, so they go ahead, they got the bill. The engineer was really nice, only sent them a bill for $48,000 instead of $50,000 that they put the purchase order for. They wipe out the encumbrance, and pay the construction expenditures of $48,000. Everybody see that? Okay. Notice what happens. New account pops up, which is what? Construction work in progress. This is what I was telling you about premium. Don't try to not make this more complicated than it is. Basically what it says is, if you sell bonds at a premium, any premium you get doesn't belong to the capital project fund. It should go towards repaying the bond. And where do you get the bonds repaid? From the debt service fund. So this is what it's saying. Capital Projects Fund received $5,050,000 for this project. Other financing source, proceeds of the bond, $5 million, and they are going to send $50,000 to the debt service fund. That's the premium. Notice the way the governmental activities is done. So you say, why is not due to due from? Remember, governmental activities is everything combined. Debt service, capital projects, general funds, special revenue funds. You don't need due to due from within those funds. You understand that? Governmental activities is what's all combined together, okay? Because even if you were to have them separate, they would cancel out when you prepare the statement. Premium on bonds payable, $50,000. So what do they do, by the way? What do you do in business with premiums? What happens with premiums in your regular accounting? You amortize it over the life of, exactly the same thing here. You amortize it over the life of the bond. Okay, so they got the cash from the federal government, no sweat here. They debited cash, credited, due from federal government. They paid the loan back because they got the money back from the, they got the money from the loan, from the bond, so they paid the loan back, okay. Then a contract was signed for $5,050,000 with some capital construction company. See this? As soon as they sign the contract, an encumbrance is set up, right? Nothing happens here. Encumbrance is set up right here. Their first bill came in for $3 million. They debit the construction expenditures. They have a liability. They need to pay the contractor $3 million, and the encumbrance accounts are canceled. If it makes it easier, split this into two entries, one for the encumbrance, one for the other, to make it easier to understand. Okay. Now notice what happens. Still construction work in progress. Remember I told you about that retainage, holding on to the money? Well, they said, we got the bill for $3 million, but we're not going to pay you $3 million. We're only going to pay you what? $2,850,000. We know we owe you what? Another $150,000. That's why, what is it? It's payable, right? We'll pay this to you after we've verified that you've done the right thing. Yep. Yes, when the project is complete, the engineer would go out, verify all the work is done, and say, release the retainage. This is how all government contracts work.
What if you want, if this is just credit cash, and debit contract payable?
No, because you're only...
2850.
No, because the thing is... No. Because see, the contract is... They're billing $3 million of the contract. So that's the amount that you need to wipe off. No, they're not similar. They're different.
But
because
that's out the 2850.
No, but this account is special because it says what? Retainage payable. This is that special portion. You need to distinguish it. Yep, exactly. Okay, next one, construction expenditures, some more. They bill the next $2 million, right? So what they bill? $3 million. Another 2 million, so what is it up to now? 5 million, right? They've built. And we do the same thing. Construction work in progress goes, again, we withhold what? 5%. So what have we withheld so far? 150, right? Previously, plus what? 100 now. So we've withheld 250,000, which we owe this fellow after we verified his work. Okay. All right. So they did some inspection. The city incurred $75,000. This might seem a little confusing. I wish they hadn't done it this way, because if the city incurred $75,000, this seems like the money is going to him, but see, was paid to the general fund, remainder to the contractor, entire liability. So what was really paid to the contractor? 250 minus 75,000. Okay, so just watch that one. Okay, that's what they do in practice. They go out, and what they do is they inspect whatever the cost is there to fix it up. They deduct it from what? The retainage. The better entry would have been what? To put in 250, right? But they did it to break this down, but they did it because they wanted to show that the entire contract retainage was extinguished by this. And now all the accounts are being closed at the end of the year. You see what happens? The $5 million, revenues, 100,000, construction expenditures that they incurred, and there is a fund balance at the end. There's one thing which, okay, I think this slide is coming out. Notice that after everything was done, they were left with what? $52,000. So does it stay in the fund? No, they close it out. They transfer the cash to the debt service fund. Okay. The answer is, so this is on the balance sheet. Think about the balance sheet. After you've paid everything, you have cash of 52,000 and fund balance of 52,000. Right? This is what's happening. You're getting rid of the cash through this account, which is then close to the fund balance, to zero it out. Okay? Don't think of it any more than it is. If I say this to you 3 times, you're going to get even more confused. What you do is say to yourself, this project cost, after I finish, I have $52,000 left. What I need to do is send this to the debt service fund. These are the journal entries to send it to the debt service fund. Okay. So now everything's completed. What happens at the governmental activities level? You need to take the construction work in progress and do what? Capitalize it all into a building. The project's done, and what does it cost? $5,048,000, and it comes in as a building. Okay, couple of things here. Building is of course included in the in the net position of capital assets, net of accumulated depreciation. The liability is reported also, and any depreciation expense is calculated. Okay, where does this all happen? In which part? General fund or governmental activities? Governmental activities. Good. You'd have broken my heart if somebody had said general fund. I'd have died. Okay. Okay. Couple of things. Capital projects fund, so you have several capital projects funds. Remember I said each one has a little separate column of its own. How do you decide which one should have a separate column? It should be what? No, in order for a capital projects fund to have its own column, what does it have to be? A major fund, right? If it's a non-major fund, what do? Combine it all into the other governmental. But is it a crime if you decided, no, you wanted it to have its own separate column even though it's not a major fund? No, people do that. GASB doesn't like it, but people do that for control. Okay? They like to see separate capital projects fund. But the requirement is that you must have, for major funds, at least that. Okay? And that's what this talks about. Okay? Some special topics. Actually, maybe there is, okay, I'll try to remember this. Accrued interest on bonds sold. You know what? If you study finance, there's nothing more complicated on this than what it says here. When you sell bonds, bonds pay interest what? Every 6 months, right? Semi-annually. What if you sell a bond in the middle of a 6-month period? The person who buys your bond also does what? Has to pay for the accrued interest to that period, right? That's what that is. So the accrued interest, and who's responsible for paying the interest? The debt service fund. So any accrued interest has to go where? To the debt service fund. And that's how that works. Okay? That's why I see it says as revenue of the debt service fund. Now, I wish I could talk to you a little bit more about bonds. I could probably spend a class, because I love finance as much as I love accounting. But, you know, but that will take us away from this. But just remember, whenever you purchase a bond, most of the time you would pay what? Accrued interest on the bond, because it's sold during 2 payment periods. Okay? And then you get it back, right? Because when you get your first payment, you get it for the entire 6 months, right? Yeah. Okay, now this is one thing you shouldn't forget, because I might just put this question in the exam, which is very unlike what you might think about, which is that interest costs during construction are not capitalized. So any interest that you incur during the time construction is happening, you do not capitalize that into the asset. You might want to, but don't. Okay? Because they are reported as interest expense at the government-wide level. You know, remember that separate line that we had after functions? And make a note for yourself. Actually, there is a statement on page 189. See how simple the statement is for the Capital Projects Fund? There isn't much here. Okay? Construction is separated from interest. Other financing sources, look at how they use it. Proceeds of bond, inter-fund transfer out, and this is how a statement of revenue, expenditures, and changes in fund balance looks like for a capital project fund. Revenues from other governments, do they have to pay it back? No, these are what? Contributions or what? Grants, right? Whatever it might be. This is what you spend, and these are other financing sources. Remember you were asking me before, during the break, see how the categories are: revenues, expenditures, and other financing sources or users. And fund balance at the end is 0, done. Okay? By the way, if you, and I apologize for this, because more than one person said this to me, I try to make things as simple as possible and assume that I'm making it as simple as possible, which is not a good thing, because there are times when they are not as simple as possible. Not everything is as simple as possible. So if I do that, don't get upset, because you know what? What I'm trying to do is, I love to teach, And when I teach, I would like to, my ultimate course in governmental accounting would be the entire course semester in half an hour. Because I want to keep it. There's a lot of extraneous stuff. If you get the principles down, everything else is, comes off it. It's like an offshoot of that. And it's the same story, by the way, with finance too. And I don't mean to minimize this, but it's true. You can learn the essence of a subject if it's done right. And I'm not saying I do it right, but that's why I'm trying to keep it that way. And some of you might wonder, why don't I go into much, much more details? It's because what happens is, you can read that in the text. By doing that, we lose the overarching principles. Because then you don't know what comes where, okay? So let's take a look at the next special item, which is arbitrage rebate. This is a very thick subject. And what this subject deals with is the following concept. The concept is this. If you're the government and you can borrow money at what cost? Tax exempt, right? When it's a tax exempt rate, what do you borrow it at? Hopefully a lower rate than the taxable rate. So you are somewhat bright CFO in a government organization said, I think I found the ultimate money-making machine. I'm going to issue bonds all over the place. And you know what? I'll issue them at 6% and invest the money at 8%. Isn't that's, brilliant simplicity here, right? That's called arbitrage, which is borrowing at a certain rate and investing at a higher rate just because you are tax exempt. We can't do that, right? Okay. So what happened here was the Internal Revenue Service said, wait a minute, you can't make this a money-making machine. What we'll do is, if you borrow money, let's say that $10 million, you use it to build your building, and within 3 years, you spend it all. Any interest you generate on that is yours to keep, even if it's higher than your cost of borrowing. But after that, and there are other rules, complicated rules, any excess interest you make over your cost of borrowing, you have to send a check to the Internal Revenue Service. Because you are doing what? You are taking advantage of the arbitrage between the tax-exempt rate and the taxable rate. So this is what this subject talks about, is this issue of, and why did it come here? It came here because there are some construction projects which go for a long period of time. So now the question is, what if there was a construction project which went for 5 years? Now what do I do? The government says, yes, this is what you have to do. Instead of buying those CDs at 8%, 8% is nowhere these days, but instead of buying those CDs at whatever percent, you have to invest in instruments which yield an amount equal to or less than your cost of borrowing. See, I can't find any. And the federal government comes out and says, no, there is an instrument we have designed just for you. And I think it's called SLUG, S-L-U-G-S, State Local Unit something. You have to look this up, okay? Which give you minuscule return back on your money. It's designed for governments who choose to do that. And if you invest in those instruments, you don't have to file this complicated report at the end. If not, you have to prove to us that you didn't make any arbitrage profit on this. So that's what this arbitrage rebate is, and that's why it comes into this discussion, because of the length of the project. As I said, we can go on about this for a little bit more, but I think it's better we stop here. Okay. And that's what it says. It has to be paid to the Internal Revenue Service as arbitrage rebate. So as I said to you, you can have multi-period projects. You can have multiple projects. If you have multiple periods, keep in mind you have to close revenue expenditures to fund balance at the end, and you have to maintain the encumbrance account at the end of the year. Because if you close it, what's going to happen? You've let out this contract. You have to keep the encumbrance account alive at the end of the period. All right, and multiple projects, you can identify, the encumbrances for those items. Special assessment projects, and here, most of the time what happens with special assessment projects, most of the time, the government issues the debt and is on the hook for it. But once in a while, they're not on the hook for it. Okay? And that's this. If the government is not obligated in any manner for the special assessment debt, then it does not even show up in the governmental fund. It shows up in the fiduciary fund. But as I said to you, 90% of the projects, the government is on the hook to pay back the debt associated with special assessment. By the way, how do they pay? So what actually happens? So you put the sewer, and every house gets assessed $300 a year. What do you have to do? Send a check to the government for $300. They get all the checks together, and then what do? In the debt service fund, they use it to pay the principal and interest. So somebody smart has to figure out that these amounts that they're getting from the property owners equal the amount of debt service that's being paid. That's how that is done. Okay, so this is just kind of any questions so far on anything? I do see some glazed looks. There could be two reasons for it. Either you guys studied a lot this weekend, that's something going on, or two, you're saying, why am I here? Okay? All right, so it's either that or with the spring fever, that's very common. But so our game plan is, as I said to you, please be here on Wednesday. We'll go through the assignments, and please bring up hard copy. And we'll try to go do a quick review of the materials themselves, so you'll know at least what you can expect. And did everyone send me their group members? Because I saw some were missing as to, okay, if you haven't, please do send it to me. Yep. So this way, I just want to make sure nobody's left without someone, where they don't belong to someone, okay? So that's that. We have a few more minutes. Everybody knows what they're doing for the CAFR, who they're going after, NJ CAFR. All right, so you're good with that, right? Anything else? You guys? Yep. Yes. Just get the building account because the value has come down. No, that's the explanation of the entry. Yeah, I'm sorry. That's the explanation of the entry, the impairment. Okay, well, yeah, hold on, one more question. Yeah. Okay, anybody else with any questions? You want to, okay. All right. Okay, we'll leave a few minutes earlier.